Hi, thanks for clicking on the video. Very often on Shark Tank, we see that entrepreneurs turn down the offers from the sharks when they do not get the valuation that they originally came in with. I've always been a believer that giving away more equity for an opportunity to partner with a person like one of the sharks is absolutely worth it. But this video is not really about my belief. It's about looking at the math at a potential scenario, what can happen in the future in both cases when you do or when you do not take a deal from a shark. Let's use a scenario very close to what we usually see on Shark Tank. Say you got product X, whatever that is, and you sell it at, say, $20 a unit. You just went through your first year, and let's say you sold 5,000 units at $20 a piece and your sales are $100,000. And now, after this first year, you appear on Shark Tank. Let's say you set your valuation at 10x as the multiplier for your sales, which puts you at $1 million. And let's say you ask for $200K for 20% of your company. The sharks listen to your story and they say, you know, today your valuation is really about $500K and we will give you $200,000, but for 40%. Now, let's take a look at two scenarios. Scenario 1 is when you got no shark, but we can assume that you did find an investor who did give you $200K for 20%. You go through another 12 months, and let's assume that you knocked it out of the park and sold, say, 4 times more units than your first year, so you end up with $400K in sales. Scenario 2 is when you accepted the offer. I think it'll be safe to assume that with the sharks' help and their access to Targets and Costco's and Walmarts of the world, let's say you sold double of scenario 1 and your sales are $800K. Now, let's assume that at the end of the second year, somebody wants to acquire you and you are willing to sell. They look at your numbers and they agree with your 10x multiplier, and in scenario 1, they buy your company for $4 million. Since you own 80% of the company, your cut is $3.2 million. Let's look at the shark scenario. Although with the numbers like that, the multiplier will most likely be more than 10x, we'll keep it at 10 for comparison purposes. So the buyer acquires you for $8 million, and since you own 60%, your cut is $4.8 million. The difference between the two scenarios is $1.6 million or 50%, and that's quite a big deal. Again, this is only hypothetical, and in reality things can go both north and south in both cases when you do or when you do not take a deal. But I think the example that we used is showing that there's a higher chance for you to rake in more cash in the future, in the long run, if you partner with the sharks, even if it means that you have to give away a little bit more of the equity. Thanks for watching.